Hello actuarial friends. SP9 is all about enterprise risk management, and this qualification is mandatory for obtaining the CERA certificate. This is a wonderfully exciting and emerging field with wide-ranging applications, not only restricted to the financial sector, but its applications go much beyond the financial sector. It is fair to say that almost any organization, any corporate entity, whether operating in aviation sector or education sector or food retail or whatever, all types of corporate entities can benefit by adopting ERM, Enterprise Risk Management. Now, in order to be a true ERM professional, we must first know our basic terminology. And since it is a still evolving subject, the basic terminology is not yet evolved with full consensus. Still there is terminology, but with some differences. Not huge differences, but some slight differences on some nuances, on some final nuances. Experts in our domain differ a bit. So it is my responsibility to keep you alerting about the differences, where one word, one term or one particular risk may be interpreted or defined differently by different experts in our domain. I will give you an alert through these videos that, okay, this is how we are defining this term within the context of SP9 and in the light of the study material provided by the Institute IFOA, but this term could be taken to mean slightly different thing in some other context or by some other expert. So, if we want to evolve into a fully recognized discipline, it is important that we must first have a risk taxonomy. So half of the risk taxonomy related issues, the in principle things have already been discussed in a later video, in an earlier video, and in this video we are going to take the bull by its horn. We start with risk categorizations. So basically there are 21 risk categories that have been agreed upon. Largely broad consensus is there, but when it comes to finer details, some differences of opinion are also there. So what are these 21 categories? I have listed all of them on the right hand side, your right hand side, my left hand side. Now, if you just give a cursory glance to this list, on the first instance, it looks like a laundry list. Almost everything has been included, right? But if you think through it, you will realize that all of these are elements of external environment. We have already discussed the actuarial control cycle. In an actuarial control cycle is a very broad level map of what actuaries do and how they do it. So they first start with the specification of a problem. Then after defining the problem, they proceed to developing a solution. And it is quite possible that while thinking through a feasible solution to the problem, we get a little wiser about the problem and we re-specify or restate the problem in a slightly better way. So there is a feedback loop between these two stages, specifying a problem and developing its solution. No matter what solution we develop, that solution needs to be implemented on the ground, needs to be implemented, needs to be offered in the form of a product or a financial scheme or some sort of financial plan or security, like whole life assurance, term assurance, health insurance, private medical insurance, or long-term care insurance. Now, whatever solution we develop, that will relate to the future. And how the future is going to unfold, very difficult to say, very difficult to predict or forecast. So, guided by the past and guided by all the information available in the present, actually will try to see into the future, and based on that, the actuary will come to a set of assumptions, and based on those assumptions, we proceed to develop a solution. What if the future fails to unfold the way we thought it would? So, for any such instance, we have to first appraise ourselves that this is what we thought and this is what actually went through. So, was the actual outcome more favorable to us than we thought, than we assumed? If yes, that is a very good thing. That is a very good position to be in. That will bring in returns more than what we assumed or expected. But what if the actual future unfolds in a way that is unfavorable to us, that has adverse implications for us? That will call for some steps to be taken to remedy the situation, to address the new problems that have cropped up. So that stage is called monitoring the problem, monitoring the experience. And when we monitor the experience, that understanding, that learning may make us wiser to handle the next problem in a much better way, or handle the same problem on an ongoing basis for the remaining term in a better way. And it can also give us some insights about solutions. So next time our solutions can be more effective. Even in the remaining period of the problem, the solution may be tweaked and may be improved upon. So this is a cycle. Understand the problem, develop a solution, monitor the experience, and keep learning all the way. But the very important thing about actuarial control cycle is that specification of the problem may be affected by external influences. So there is a general commercial and economic environment. Regulator is part of that environment. Law is part of that environment. Societal attitudes are part of that environment. Morality is part of that environment. Competitors are part of that environment. The broader economy is part of that environment. The policies of the government related to the economy, fiscal policy, monetary policy are all part of that external environment. So, what exactly is the state of external environment and how it is likely to be some time from now, 10 years from now, 15 years from now, 20 years from now? In the light of that, we will define a problem, specify a problem. And in light of all that, we will develop the solution. And even when we monitor our experience, we need to know whether the changes that we have actually experienced are transitory or temporary, they are not going to be repeated in future, or is this the new normal? Has it become permanent? So we can experience the same thing in the coming years also. So a survey of external environment is very, very important for a good job of actuarial nature to be done in a proper way. And all this must be done with professionalism. This in nutshell is the actuarial control cycle for you. Now, why I am raking up actuarial control cycle in the chapter called risk taxonomy? Now with this thing in mind, now look at the list again. You will find that all of them relate to external environment. Any aspect of the external environment that can change can be a source of risk. Of course, it can change favorably, so that is the upside potential of that risk. But it can also change adversely, so that is the downside potential of the risk. And enterprise risk management says that we must not only focus on the downside, we must not only focus on the upside. For a healthy, holistic risk management, we must focus on both the upside as well as the downside. So what can change? Market. Market, maybe financial market, non-financial market. Just to give you one example, how this can be a source of risk, change in the external environment. So let us first consider implication, just for an example. Similarly, we can have implication for each of these 21 risks, right? That will make the video just too long. So anyway, all these risks are going to be discussed in detail in later videos, in later chapters. So to keep this video short, reasonably short, I will only discuss implication of market risk, right? Now when I say market, please don't think I am always referring to financial market. So it may be financial market, it may be non-financial market. When it comes to financial markets, shares, bonds, debentures, various derivatives, these are the things that are being traded on the market. Non-financial market, commodities, in raw material, input, output, finished goods. These are things sold in the non-financial markets. Of course, it is quite possible that a detailed discussion of non-financial market may not be that important in an insurance contract for financial sector companies, but may not be completely out of place. It may be more important for some other clients. But for a comprehensive understanding, we must understand both. Okay. So let me focus on financial markets. When in financial markets, just imagine one thing. Your client or your employer would also be a corporate entity, and its shares, its bonds would also be listed in some financial market. They must be traded in the stock exchange. So what if there is a large fall in the value of the own stock of the insurer? For right or wrong reason, forget that. I am focusing on implications. So if own stock price falls by a large margin, what might be the implication? We may become a target of hostile takeover, right? People will find it easy to acquire our company. The cost of hostile takeover will be drastically reduced with a massive fall in the share price. And it is quite possible that it comes in a package deal. There is something which has affected our reputation also. So a lot of our shareholders may be willing to make an exit, and our policyholders may not be happy. On top of it, regulator may not be happy. So we will become an easy target, easy prey for hostile takeover. So if ERM is adopted at the very top, if it is the board of directors which champions the ERM adoption, so it is in the interest of the board itself, because once the company is acquired by someone else in a hostile takeover, once this hostile takeover bid succeeds, they may supersede this board, so the board may lose its relevance. A major overhaul might be there in the board. So board of director must always be interested that this is a possible risk and which of their actions can precipitate this risk. So that also gives them an incentive to keep running the corporate entity in the best possible way, to ensure high standards of corporate governance in their organization. That is their incentive. So this is implication of just one risk. Okay, what if there is a big movement, not in our own stock, but stock of other companies? Or let us say one of our competitors. So that competitor may become an easy target to be acquired. And if we have the financial muscle, we can command the money. We can buy that out. That is also possible. Okay. So apart from merger acquisition, are there not more implications of financial market? There are very lot. What about investments? What about investments? If you think from point of view of a purely financial sector company, it will have liabilities, but it will also have investments. So what if there is a large fall in the value of those investments? There may be host of problems, a hell host of problems, right? Full range of problems. Asset liability mismatch may be there. The problem to manage cash flows will be there. There may be pressure of premature withdrawals by the policyholders. How will we manage? How will we cope? And of course, our even very solvency might be threatened. And there may be call for infusing further capital. And the cost of raising that additional capital might be very difficult under such circumstances. So these are the implications of financial market risk. What if there are large fluctuations in a non-financial market? Okay, financial sector may not be much worried about it all the time. Only some very exceptional cases may affect us directly. But what about a client which is a non-financial entity? So their risk is that the cost of input goes up very high. So they will struggle to survive. And if at the same time the price of output falls, that will be double whammy. So each of them is a risk in themselves, right? Price of output crashing or price of input rising. And what if they both happen simultaneously? Very difficult situation to be in. So that was a brief idea of how each of these risks may have consequences, may have implications, right? To foresee these implications, and to make advanced preparations to be able to withstand these implications is here. So, having discussed implications of market risk, I return to the categories of risk. So, the way to consign this list to memory is to appreciate that what elements of external environment we must survey, we must keep in mind while doing actuarial job. So if you focus on external environment, this list will be easier to remember. Now look at it. First is market risk. This is always on top of mind of actuaries, right? Asset liability management, asset liability matching, asset liability modeling, right? This is always on top of our mind. Because we usually get to work with financial institutions like insurers and pension funds, right? Either directly or indirectly, we were mostly working for financial institutions. So it matters that how their investments are faring, whether their investment values are above their liability values or not. So that risk is very easy to keep in mind, memorize. Next is general economic environment. How many things can change in the general economic environment? demand, aggregate demand can fall, aggregate supply can rise, business cycles, recession, depression, monetary policy, fiscal policy. So those changes may be a source of risk, may also be a source of profit. So risk is not always a bad thing. Risks have both upside and downside potentials. So the next is, now we must remember time value of money. Time value of money is a big concept. You can't be an actuary without time value of money. This is well ingrained, drilled into our brains. And in fact, our very journey in actuarial science begins with the idea of time value of money. So time value of money is a function of interest rate. So when interest rate changes, time values change. So next is interest rate risk. Very easy to remember. Okay. Now, next is currency. Currency risk or foreign exchange risk. Of course, not every organization may be exposed to this risk. So that is not our case. What we are trying to do is, we are trying to make a comprehensive, exhaustive list of risks, right? So that we are, as risk management professionals, we are able to help all types of clients, all types of clients. Next is basis risk. Now, why basis risk is important? Why it is so high on the list? Because that many actuarial techniques would require some sort of hedging, either complete hedging or partial hedging, some sort of hedging. Hedging gives us a peace of mind. Hedging hedging is one of our risk management tools. But do you think that as of today there are enough indices, inflation indices, stock exchange indices, cost of living indices, there are enough indices, tradable indices exist that we can always achieve a perfect matching? No, sorry. That is sometimes not possible. So sometimes our hedging is not perfect. It is slightly imperfect. Why? Because we have exposure to index A, but our underlying asset in our hedging is index B. So though index A and index B, like NSE and BSC, though they almost move in tandem, the correlation coefficient between them is not 1. It is less than 1. So we have to have an index tracking fund. But the index we are supposed to track, on which derivatives do not exist. So I cannot have a direct exposure of that index, neither an indirect exposure of that index. So I take some similar index. So the similar index is similar because it moves broadly in line with this index, broadly, not perfectly. So that a small gap is left. That is called basis risk. Right. For example, of all the foreign currencies in which you may have liabilities, you may have commitments, right? Not all those foreign currencies may be easily tradable or deeply tradable. So their markets may not be well developed, may not be deep markets. So basically we will be managing it through dollar or euro. These are the most common, or maybe pound, dollar, pound, euro. Even if my liabilities are in yen, I have written a lot of business in Japan. Even if my liabilities are in some other countries, say Mexico, so my liabilities are in pesos. But where is the pesos index? Tell me. So how will I take a direct or indirect exposure to pesos to manage my risks? So that is why basis risk is so much high on the list. We must always be aware. Because in a way, you may say that basis risk is not entirely because of external environment. To some extent, we are also contributing to the basis risk due to the choice that we have made, that if this is not available, let us use this to hedge. So that was a conscious decision, right? So if basis risk is so high on top, and so we will always be reminded of this, that the choice that we make should be as close as possible. Should be as close as possible. So basis risk should be as small as possible. So there is something that we can do. This is not entirely on external environment, right? Now, the exposure that I have to yen, but I don't have a good tradable index on yen, that is because of external environment. But now which currency I choose, that is my choice. So to some extent, our own action can go a long way towards ensuring that there is little basis risk. But it cannot be completely eliminated. Next is credit risk or default risk or counterparty risk. Now again, within financial sector alone, there is very little counterparty risk, very little, right? We generally don't have trade debtors. We do not sell on credit. Okay, your policy starts today, you may pay premium 3 months from now, 4 months. We don't sell like this. The only counterparty risk that we encounter in the financial sector is when we sell our business through brokers and we allow the brokers to collect the premium. Keep the commission part and brokerage part with themselves and deposit the rest with us. So then these deliveries may be, these recoveries, these deposits by our intermediaries may be slow, may be delayed, or they may go bankrupt, they may default. So within financial sector, the counterparty risk is not huge. And again, it is not entirely an external environment thing. We can design policies keeping in mind, right? We may not allow them to collect the premium in the first place. We may have an agreement in place where the premium comes directly to us and then we pay their commission out of that, quite possible. Of course, not possible in each and every situation, but we can work in a way to keep this restricted to as low as possible. But when it comes to interest rate fluctuation, right, that is entirely a thing of the external environment. When it comes to fluctuation in aggregate demand and aggregate supply in an economy, GDP fall and rise in an economy, that is purely an external environment thing. So, credit risk, the counterparty defaults, the issuer of the bond defaults, the issuer of a derivative defaults, fails. So, this is credit risk, which is faced by almost all corporates. But counterparty risk is very high when we come to non-financial companies, non-financial clients, non-financial sector clients. Okay. So, since this chapter is on risk taxonomy, I am briefly touching upon all these ideas, not exploring them in great detail because they are going to be the subject matter of later videos. What I am doing right now is giving you a key to consign this long list to your memory. How you can consign it to your memory, right? So then comes liquidity risk. Now we will discuss liquidity risk in great deal. Liquidity risk can be further broken down into 3 types. Funding liquidity risk. Suddenly we have a large liability outgo which was not anticipated. Something precipitated the liability prematurely and now we are suddenly in need of money. Can we raise the money from money markets easily? Usually it is easy. But under certain conditions, when the markets are stressed or liquidity crunch is there or investor sentiment, investor confidence is low, right? Future is appearing bleak, so nothing earth-shattering has occurred, but it is on the horizon. It looks like on the horizon. So everyone is keeping their finger crossed. So during such times, it may not be possible to raise money easily from the money market to discharge of this one-off liability. And the funny thing is that such premature precipitation of liability is much more likely, much more common during such times of economic uncertainty and impending doom on the horizon. People may get panicked and may withdraw their policies prematurely. There may be a run on bank, right? So this is funding liquidity risk. But liquidity risk can also mean cash flow management risk. Like there is asset liability matching, similarly actuaries would like to do cash flow matching risk. Inflow, outflow, matched in timing and sizes. That is called cash flow management, right? So what if at the time of a outflow we do not have matching inflows? Outflows occur as per my projection, nothing wrong. I am good in projections. My actuarial techniques, my actuarial training is helping me, but the projected inflows do not materialize. Quite possible. Like if the doom is on the horizon, it is impending. If the market sentiments are low, investor confidence is low, policyholder confidence is low, so the sale of new business may not proceed as expected. So those inflows may not arrive as per my projections. So then I will face liquidity risk. There is third dimension of liquidity risk also. That is, you know one thing, since Corona times, since the lockdown times, India's central bank, Reserve Bank of India, has been buying gold like crazy. By last count, when I last checked, it had already bought 220 tons, not kgs, tons of gold, pure gold, in the international market. And it did it in tranches, the small tranches. Sometimes 5 tons, sometimes 4 tons, sometimes 13 tons. Why? Why didn't go about buying this in one tranche? And it is still buying. So maybe it will stop after buying 500 tons or 600 tons. Why doesn't it declare that this is the quantity that we intend to buy? You know, even this declaration alone will move the market. Gold prices will soar, and the gold will become very costly. So markets have a certain capacity. How much demand they can absorb at a given time. Similarly, how much supply they can absorb at one time. When I say absorb means without upsetting the market, without sending the price like a rocket or like a submersible. So if we know how gold prices change over time, we know that in a day, 0.2%, 0.3%, the maximum, 0.1%, 0.05%, 0.002%. This is the norm. Gold price in a day change very little. But if RBI announces, though, we have a target to buy 1,000 tons of gold. In one day, gold prices might jump by 9, 10, 11%. One day. Now that will upset the market. So market doesn't have the potential to absorb this much quantity. Similarly, if some central bank announces, we have planned to sell 600 tons of gold, just this one single announcement will crash the market. Gold prices may fall by 12-13% in one day, just with the announcement, without even 1 ounce being sold in physical unit. So that will upset the market. So now forget gold. Suddenly you have a large premature withdrawal pressure for whatever reason, your reputation is at risk or whatever, and you want to pay all of them so that the rumor die down. No one continue to harbor any doubt about your solvency, so you want to pay all of them. And you hold sufficient assets. Now, the moment you go to sell, you go to liquidate a large tranche of your asset portfolio in the markets will crash, and you will end up realizing a very poor value. And there is a name for such sale. It's called distress sale. So liquidity risk encompasses all the three. So we must work to ensure that we do not hold a large quantity of one single asset. So when we have to liquidate our asset portfolio to pay off a large outgo, we sell many assets, not one asset. 1 crore from Tata Steel, 3 crore from MRF, 4 crore from Bajaj Motorcycle. That is easy to liquidate and pay to the client. But 140 crore by selling Infosys, it will upset the market. It will crash the market. And you will end up realizing poor value. So then operational risks. Oh, this is not external environment. This is completely insider job. So you may think of it as an exception, or you may make two lists or three lists: entirely external factor, entirely internal factor, or combination, mix of two. Then environment, like climate change. Then regulatory, enough said, enough discussed already about it. Legal risk, changes in law, legal pronouncement, political risk, agency risk, reputational risk. Reputational may not be entirely external. At times, there may be some lapse on our part also. Project risk, strategic risk, demographic risk, moral hazard, discussed in detail already. Conduct risk, other risks like social and pension risks. No, they are going to be discussed in detail in later videos. So here the idea is to give you a category of list which is broadly agreed, right? Okay. Now one thing. Two important points that I will discuss. Consistency of categorization. Is this accepted by each and everyone? I give you just one example. Is foreign exchange risk a market risk or an economic risk? Tell me. Okay. This is not as puzzling a question as you might think. The resolution of this is very easy. The answer, the key trick lies in what you want to focus on. You want to focus on origin, or you want to focus on effect or consequences, right? If the basis of your categorization is origin, then foreign exchange risk is 100% economic risk, no doubt about it. Open and shut case. If your focus is on origin. Like I say, think all these risks originate in the external environment. If the focus is on origin, without any doubt, foreign exchange risk is an economic risk. But if the focus is on implication, consequences for us, consequences for my client, right? So foreign exchange risk would mean what? Some asset. For me, dollar is an asset, pound is an asset, because my currency is rupee. I am an Indian, so my currency is rupee. Dollar and pound holdings are my assets, like investment in Tata Steel, like investment in Infosys, so investment in dollar and pound. So either those investment value will go up or will go down depending upon how exchange rates have moved. Similarly, if I have to pay claims in UK, travel insurance related claim where the person got treated in UK, I have to pay claim in US. These are my liabilities foreign currency denoted liabilities. So my liability has gone up or gone down in value. So if you focus on the effect, then again it is an open and shut case. It is undoubtedly market risk, no doubt. No argument here left. Similarly, interest rate risk. Is it an economic risk or a market risk? Again, it depends. You choose to focus on origin. What factors lead to interest rate fluctuations? What causes interest rate fluctuations? Then it is the forces of the economy as a whole. It is a product of economic forces plus government policies. Of course, government intervenes depending upon which way it wants to nudge the economy. So it is a combination of the decision of the government plus the overall economic scenario. So if you focus on origin, it is no doubt it is an economic risk. But now come to focus on implications. How will it hurt me? It will hurt me by making my bonds cheaper or costlier, by changing the present value of my liabilities and by changing the present value of my asset. So then, again, no doubt left, it is market risk. And this we discussed in our previous video also. The moment you focus on risk taxonomy, you have to first think of a criteria. What is your categorization criteria? So categorization criteria may be origin. Categorization criteria may be consequence, effect, or some other. Nature of the risk. Controllable, uncontrollable. We have another classification. This is nature, by nature. Systematic, non-systematic. This is categorization of risk again. So any of this can be systematic or non-systematic. Categorization may be based on nature. Similarly, you have another categorization: small risk, large risk, size. Similarly, you may have other categorization: insurable risk and non-insurable risk. So, consistency of categorization depends upon criteria of categorization. That is the key. So, it is quite possible that we are uninformed about this. We take two experts, we take their books, we copy down list from both the authors and we say, oh, they don't agree. Oh, sorry, sir, they don't agree. So, how on earth you think I can produce a risk categorization? But first make sure whether these two authors, two authorities, two experts whose lists you are trying to compare, whether they use the same criteria for categorization. It is quite possible that one of the experts have chosen to focus on origin, the other may have chosen to focus on nature, the third one may have chosen to focus on the effect. So their list will never agree. They will never be same. They can't be same. But of course, if you have two experts, both categorize this based on origin, and then if their categories do not match, right, then there must be some finer points, some nuances that you have to go into to figure out that why Mr. A says it is risk A, while at the same time Mr. B says no, it is risk B. So you have to catch those nuances. And it is exactly for these type of purposes we have professional conferences and seminars, where experts get to have a healthy exchange of ideas between them. Only then a consensus emerges. So it is hoped that sometime soon, very soon, say 5 years down the line or 3 years down the line, a consensus emerges in our field also. But as of today, it is your responsibility to catch those nuances. Okay? So we have done with consistency of categorization. I would still recommend that there is a very small part, say just 1 page, devoted to consistency of categorization in the official study material. I would encourage all of you to go through that page And after going through that page, if some questions crop up into your mind, I would be more than willing to address them. So that will be the stuff of the doubt class. So I do hope you already understand the difference between systematic risk and non-systematic risk. Now, see, the moment we change the criteria of categorization, that means we have changed our viewpoint. We are looking at the same thing from a different angle. Why I am saying so? If you remember CM2 or CT8, systematic risk is also known as non-diversifiable risk. And non-systematic risk is also known as diversifiable risk. So it is not simply a change in name. It is also a change in viewpoint, change in categorization criteria. When I say it is non-diversifiable, so what does it mean? My criteria has changed to solution, not the nature. If I spread my money over a large number of assets, even then my portfolio will remain exposed to systematic risk. So diversification is not a solution for this. So risks that I can handle through diversification are called diversifiable risk. Risk that I can't handle with diversification, I would need something else, or I may not be able to handle them at all, are called non-diversifiable risk. So whenever you come to this taxonomy, whether in your studies, whether in your professional careers, or whether under an exam situation, always try to figure out the criteria for putting risk into various categories. Only after understanding that criteria, you will be able to proceed with full confidence, and there will be no place left for confusion. Okay. So I'm not repeating systematic and non-systematic risk here, but I do need to discuss systemic risk. And you know one thing, what I call systemic risk, the study material does not call it systemic risk. It calls it contagion. Contagion is like COVID-19. Nobody knows who is spreading it to whom. Nobody knows from whom I am contracted this disease and who have been the victims to whom I passed it on. So contagion is that sort of thing. It spreads from unhealthy to healthy, and very soon the entire population may be at risk. And we became acutely aware of this possibility not during COVID, much earlier than that. We became acutely aware of this problem during the 2007-2008 global financial crisis. At one point of time, it threatened to undermine the entire global financial system. It looked like the entire system might crash. It might come tumbling down like the twin towers that were attacked by terrorists on 9/11. So, the risk that the entire system may collapse is called systemic risk. Now, why it is also called contagion? Because that the problem starts in one part of the system. At the initial stages, the entire system is not affected by it. Only a small part is affected by it. But if you have seen a spider's web, like a Spider-Man's web, the financial system is so interconnected, so interwoven, right? You don't know who has exposure to whom, right? You might be wondering, you might not be aware that you are even exposed to the risk of a financial institution failing whose name you may not even have heard. You may not have traded with that financial institution at all. You may be holding no product issued by that. None of the financial securities issued by it. but still you may be affected by its failure. I write a check to Mr. A. Mr. A puts it into his bank. But his bank goes under. So, though the money is deducted from my account, from my bank, Mr. A still can't pay his clients. Why? Because their bank is not operating. His bank has failed. Now, Mr. A has obligations to employees, obligation to customers, obligation to vendors. Now Mr. A is stuck. The bank account is not operational. He is not able to make payments. So what will happen to all these people? It will trigger a domino effect. Since these people will not receive payment from a large client like Mr. A, they will also have trouble paying their liabilities further down the chain. You see the effect multiplying. If the bank with which Mr. A was banking, even if it is a small bank, having just 10,000 account holders, each of those 10,000 account holders may have obligations to a large number of other people, so they will default. Once the account holders of Bank A default, then the victims of these defaults, they will default on their payments. They will have to default. And then you don't know which organization fails. This will further aggravate the problem. Then some other organization will fail. So because of this strong interconnection, interwoven, this tight embrace, we call it contagion. So I would like to reckon it with this. We have put in place very, very effective flood control management systems. We have put in place a lot of flood control management systems. They're very good. But what if a tsunami strikes? They will be no good. They will be no good. So systemic collapse, systemic risk, collapse of the entire system or contagion has all the potential of turning into a tsunami. And that is the reason governments all across the world have to, and central banks all across the world had to act with alacrity, with concern, and on an urgent priority basis. They pumped in money to save these organizations from failing. Bailout packages, quantitative easing, and whatnot, to avert the collapse of the system. And you know one thing, it is not the case that if American institution fail, it will be related to USA only. UK institution, European institution, they will also fail. It is for this reason it is called global financial crisis, not US financial crisis. Once upon a time, there was a magazine called Alpha. It was the magazine of hedge fund industry, the hedge fund industry. And why they used to call it Alpha? If you know CAPM, Capital Asset Pricing Model, Alpha is a measure of non-systematic risk, diversification, feeble risk, and beta is a measure of systematic risk. And the conclusion of the CAPM model is that market does not reward for taking excessive non-systematic risk. Because it is within your control, you can diversify it away. Diversify it. Why have too much systematic risk? You must not have. But market do reward taking high systematic risk. Expected return is higher if the systematic risk is higher. So they would proudly say, they would proudly declare, the hedge fund industry in US would proudly declare that we are Alpha. We know how to take excessive non-systematic risks and make it work. So we make money out of non-systematic. We do not believe in diversification. We do not diversify. Now, metaphorically, the adherents of CAPM say that don't put all your eggs in one basket. If that one basket falls, all your eggs will be broken and you will have nothing to eat. In parallel to this metaphor, the Alpha magazine, the hedge fund industry would say that do put all your eggs in one basket, but then watch that basket very carefully that it does not fall. So it is a kind of swagger. It is a kind of swagger. It is a kind of sort of arrogance, or to put it mildly, it is sort of overconfidence in your abilities. It is a sort of overconfidence in your abilities that you can take risk and manage that risk and you can make money out of that. None of that swagger is visible, none of that swagger is seen. All that swagger is gone. Now it is thing of past post the 2007-2008 global financial crisis. So we have learnt our lessons. We have learned some humility that there are certain limitations to which we can do it. And that gave an impetus to this evolving field called ERM, Enterprise Risk Management. So that is all in this video. Thank you. Keep watching this space for further videos on ERM. For a full course on ERM or SP9, you can contact me using my WhatsApp number. Thank you.